G'day traders, Stacey Burke from Stacey Burke Trading, and today continuing our discussion on building your best playbook trade setups. I received quite a few emails and questions, and apologize if I haven't answered everybody's. I just try to hopefully incorporate the information in the videos. The point, one of the points I tried to hammer home yesterday in the video regarding building your best playbook trade setups is that my focus is not on how many pips I can get. My focus is on scalable trade setups that work for me in terms of me realizing and filtering out all the things that are going to interfere with me being consistently profitable, and then specializing on some key setups that I know I identify with in terms of seeing those on the charts, knowing how they should behave, and knowing that I can scale into them or add size into certain ones for big moves or heavy moves. It doesn't have to be a large range move, but I want to know a market's about to collapse if I'm shorting it, or it's going to burst if I'm going to be going long. Same setups, just flipped in reverse. Long side, short side. I have a tendency to be biased to the short side, but I will look for the exact same trade setups on the long side. And we'll look at a couple of examples. I talked about day 1, day 2, day 3, day 4, day 5. And I just start the cycle over on Monday. We'll look at a couple of examples of where the 3-day setup started last week. There's a day 1 trade on the yen yesterday. That was a 3-day setup. And we may have some of that happening this week already on a couple of the Aussie, New Zealand. Whether those will come into fruition is, I have no idea. But again, the process is the same every single day. So I love that people get on there and they go backtesting, hindsight trading, and everything else. You've missed the point completely. If you don't have the process, history shows us how these markets behave only because these markets behave in a certain way for a reason. They're designed to trap traders on the wrong side and then move to the opposite side. That's how they shift money from one account to the other. If that process wasn't in place, the market would sit in one spot all day long. So recognize that it's a structured plan throughout the day in order for a large player to either accumulate a position, get out of a position, and then there are certain market behaviors that are designed purely just for trading back and forth, trapping traders and shifting the market, margining them out in some cases. When we have level 3, that will blow out traders' accounts that chase trend following trades into the highs and into the lows. So the whole point is about making money. And if you master some setups, if you were in the medical profession, if you wanted to be a general practitioner, you can see a little bit of everything and be master of none, but you're the first gatekeeper on people coming in through the health system. And at that point, they refer you to specialists based on how you may present, if it warrants further investigation. My approach is to specialize on some very simple setups that I know have a high possibility outcome, and they're also scalable in size because they move fast, they explode. For a reason that they have volume trapped and they're going to burst away quickly to hit stops or to trigger breakouts, or to continue an already existing strong underlying trend. So we talk about the 3 things that markets do. They break out and reverse. False break reversal. They trap traders on breakouts at the highs or at the lows, and they reverse. We have markets that break out, pull back, and continue. They're trend markets. And then we have markets that are in a trading range. People say, oh, that's choppy, it's this and that. Well, if the trading range is 75 pips or 50 pips, it may be still a very high possibility setup for a 25 pip burst that could be scaled into. Not, at your max limit, but it might be a perfect setup that's about to drop through the floor or to burst through the high, even though it's a tight trading range. So there's some key setups, and again, I come back to build your playbook. Hindsight has nothing to do with it. I can show you 10 identical trades on multiple different pairs from over 12 months, exact same setups. So if you're saying hindsight, I can guarantee you're probably not making any money. And I would sit down, put your pen to paper, take some notes, and do some homework, and pay attention to what I'm trying to explain to you. Master some simple concepts. Don't worry about trying to get how many pips you can get a week. Worry about, am I able to scale trades in size so you can get into the right direction? There are some markets that may move 100 pips in a day, but they might have been very difficult to have traded, to hold on to with any degree of size because of the way the auction process worked back and forth all day long versus a market that may move very strongly and quickly, 25, 50, 75 pips, or more in some cases, depending on if it's at the high of the week, the high of the month. So one of the challenges that retail traders face is consistency. And one of the reasons why that is they're always trying to figure out the market and then get in to catch a move, as opposed to waiting for the markets to set up, knowing, we're going to look at some setups. I talked about using the scanner yesterday, and we'll revisit that because there was a lot of questions about that and how you can use that to possibly at least hone in on an instrument and then look at some of the comparable instruments. For example, if you're trading we'll look at the US CAD, and we'll look at how the US Swiss and the US Yen, which are all three US cross pairs of the majors, how they were set up and how they traded. Because there's three different setups, two very identical and one different, but they all delivered on the setups. So I was on the phone with a friend of mine in Canada in the gap time, and we were looking at the scanner. And again, yesterday, just to keep it simple, you can just put the major pairs, and I was looking at percentage change, and I was looking at the range from high to low just in my head. It's pretty simple if you're just looking at the six majors. You can look at the minor pairs as well, depending on what your spreads are like and how many instruments you want to follow. But I'm just looking for some simple setups. So if a major pair shows a setup or a possibility of a setup, then maybe I'll look at some of the crosses. But we'll look at what happened, what transpired. So yesterday at that time, the Canadian dollar had showed the greatest percentage of change from the open of the day. So its range was around 50 pips. And so I brought that up in the gap time, and it was roughly right around the 1300, 1315, so 6 to 7 a.m. New York Eastern Standard Time, somewhere in there. And I said at that point, the market, if you'll notice, went up in Asia over 50 pips from open to start. There was a gap from the beginning of the day, so it's gone up over 75 pips from the close of Friday night, almost 100. It locked in the high. Now, people ask me this, how do you know if the high or the low is locked in? Timing, based on the timing and the number levels. So when I come to the Europe session, we're inside of the high and we're inside of the low. What does that tell me? That tells me we're inside. It's pretty straightforward. There's no funny business. That's the high and that's the low. Now, they also, on the way up, put in a middle structure and they engulfed it. Two middle structures engulfed it, but they went above the major round numbers and came back inside. That tells me that the double zeros may be the high of the day. Now we have a gap and we have Friday's low. So technically speaking, this big gap up is a large bull candle. That shift candle brought it up 50 pips on the open. They went sideways, brought it up another 50 pips, traded inside of the peak formation from Friday, and then came down. London popped up, made a lower high, again at the numbers. This is in the U.S. gap time. So for all you hindsight rear view mirror traders, you can get your jollies on that one. Follow the process. They popped it up and came back down. This is a broken market now to me. Broken meaning it's breaking down. It's weak. It's weak and it's breaking down. They came down in the gap and tapped the low and came back up 1, 2, 3 in the gap. And I said to my friend, if they come back up into that peak formation at the beginning of the U.S. session, this is going to give us a great short trade down. Now, 1, 2, 3. Forget everything now on the left. We'll just block this out for the moment. I want people to grasp the concept of once you've identified your target market. We know the low of Friday is down underneath. We'll just block this out. If I can get this to come up. We'll block this out. We'll color it in. We'll make it black. I'm looking at the U.S. session. This is all I want to see. That's the low. The current low of the day is right here. They come up 1, 2, 3. There's yesterday's low, the blue line. We're at round numbers. We're underneath 50. They come up 1, 2, 3 and engulf it. Just on the 15-minute, there's your 1 bar stop. Okay, you can get in at the close. It doesn't matter. You've already engulfed. You can trade on the pullback. You can get half a position in. You can get half on the pullback. You can go full size. It doesn't matter. Now, this low of the day offers us a possible measured move as well. That forms a high and a low of a geometrical structure. That high-low now, if this market proceeds to head down to the previous day's low, will give us possibly a measured move, which it did. In this simple case, if this pair gives us 40 to 50 pips, I'm taking the money. I know I don't have zero expectations that this type of setup is going to be, going 180 pips. I'm looking for the move through the previous day's low. The average stop hunt is 25 to 50 pips outside of the range. Previous day's low roughly is double zeros, give or take. It's at roughly 90, and the quarter level is below that at 75. Now that's a 25 pip extension of that double zero box. So again, breaking out of the double zero box, 25 pips past the previous day's low, pulls back and continues down before locking in the low and heading into the consolidation. Now just purely on timing, this is a 1, 2, 3, 45 minutes. Some traders on the shorter time frames, of course, are going to be looking to get in at the high of the session. That's the high of the day for the U.S. session. We'll just get rid of the black now. So these are all the multiple factors you can be thinking of when you're really focused on sniping the best fills. Now some of that fill may be somewhere between 30 and 40 in there. It doesn't really matter. The peak formation is above the quarter level. We want to get filled above the quarter level. Our thesis is this is going to go 25 to 50 pips. It may have gotten down here and gave us sideways price action to exit that market. Now once this trade starts, okay, this is the end of the first hour, that bear pin engulfment. Once this trade starts, I know we're going to be in this for at least 1 hour. That's 4 more bars, and then it continues down for another hour. On the 1 hour, that's a 1, 2, 3. So these are some things in regards to time compression and time rotation. But coming back to building your playbook, knowing what you're looking for. This is an example of a broken down pair. It's already broken down, put a peak formation in Asia. They've broken down in London. They've popped back up into the breakdown. They've come down to the low of the day and come back 1, 2, 3 to continue the move down. That's an easy trade setup. Now the Swiss franc was very similar. They went into consolidation, so the daily range was less until it broke out in London, which expanded the range. They came back. They had already gone through the previous day's low, and you'll notice the previous day's low now, becomes a ceiling at the beginning of the U.S. session. So talking about a market that's broken down, so we're looking to continue that move for the collapse down in line with the existing broken market. If we go to our 1 minute chart, again we see the pop up 30 minutes into the first hour. At the end of the 30 minutes, the next 15-minute bar opens on the 1 minute, the market starts to collapse, and there's your fast explosive move down in an existing downward broken market back to the low of the day and continues down lower. So I don't care about trying to figure out and show people how much I know about the markets and which way it's going to head or anything else. I'm looking for setups. I'm looking for setups on any instrument. Now, the bulk of my trading is on gold and Nasdaq. If we look at the yen, this move started on Thursday. They brought the market up vertical and they held it up there. They kept it up there. Friday came back down, put a low in place, and again, just while we're on this, so important to really study the behavior of price around number boxes. You'll notice that the market comes below the quarter level and puts a low in place. That is locking in the low at the quarter level. They locked in the high at the 50 level at the beginning of the day. This is our consolidation. The buy comes out of London at the low of the day inside of a low of the market that's locked in the Asian session. This pin down in the London market gives us our ability to enter the market heading back to the high of the day. But that's Friday. They bring the market up, and then they stay in a 25 pip consolidation all day yesterday during Asia and London. And again, there's your peak formation low locking in the bottom underneath 50. They come into the London session, they do the same thing, they keep it in there. Everything else is inside. You'll notice if you were long off the bottom, this market, other than the pin up, didn't take you very far. Now you'll also notice that this 25 pip box is all caught up top. So they've come up from Thursday, 125 pips. They're holding volume up here. This market breaks down later in the gap time, breaks down into the open of the U.S. session. This middle structure is already in place. We have our low of the day in place from Asia. So it's about recognizing the opportunities and the setups. This market was held up high. It was ready to collapse. It rolled over. It rolled over right into the open of the session. You'll see the pop-up, but even more importantly, the trade was enterable on the 1 minute. So if you don't know where to get in here, there are two things I'm going to suggest. Understand the market's already broken down. We want to sell high in a broken market. We want to sell high. There's your 1, 2, 3 right to the numbers. Number two, I want you to understand time compression. 15-minute false move. They come back in the second 15 minutes with a high in place in a broken down market. They come back a second time right at the end of the second 15-minute candle. This engulfment candle on the 1 minute, we'll blow this up. This engulfment candle on the 1 minute is the last 1 minute bar of the second 15-minute candle in the 12 candle window. So now if you stand and look at this, we have a head and shoulders pattern inside of a broken market. It's a peak formation already just as we head in. Traders were already in the market. They were already short. They gave you a chance to short it here. They gave you a chance to short it on the engulfment, and then from there the market fell. So there are three simple setups that are all US dollar crosses. So again, you can look at one setup and then look at the other two on the major pairs. And you can do the same thing for the euro, the pound, New Zealand, and Aussie. If one of them looks strong if it's going up or weak if it's going down, you can compare them to see which one looks like the best setup. 25 pips a day, one standard contract, 4 days a week is $40K a year. I would rather make 25 pips, 25 to 50 pips, and make 4K a day than make 25 to 50 pips and make $50 a day. So, or 200 pips for $200. So if you identify these setups, and there's going to be trades every single day, otherwise the markets are sitting still. Now, gold and Nasdaq, we'll look at them in a second. I use two approaches with the numbers, but there's plenty of opportunity for scalable trade setups if you master some simple setups. Oops. Okay. Now with gold, Nasdaq, oil, I have my number boxes set up just slightly differently on my 15-minute charts. So if you want the numbers, if this is ones for gold, I just add an extra 0. Okay, so they're 125 pip boxes. And the reason is that I want the range, these 125 pip increments seem to be where the weekly cycles trade off of. Now, what I do with that is once Asia's set up a range, if there's nothing set up for Asia, we're going to go back and I'm going to just show you how the numbers consolidate volume and help you identify explosions outside for stop hunts. So before the session starts, we have a peak formation, we have the gap, and then we have a peak formation inside of the gap, and that locks in 50. 50 is the high at this point before the Asian session, just as it starts. So 50 is the high. The market then proceeds to auction down and pull back, making our double zeros as the low. But then the market proceeds to fall further lower, locking in the quarter level now possibly as a high. Now I work from 50s and double zeros. So the quarter levels don't really mean much to me if it's a quarter level turn. Other than at the higher low of the day, it doesn't really mean anything unless I'm trading in line with an existing trend. So the market then proceeds to trade below and pins off of 50, locking in the quarter level. Except that what that's telling me from the earlier bar right at the beginning of the day is that 50 is our box. And you'll notice this is a 100 pip box, 50 and 50. So typically speaking, each day they'll set up a 100 pip box. They did the same thing the previous day. You'll see 50s and 50s often with gold and Nasdaq. Now, what happens is that once the Asian range is done and they're inside, if they've consolidated inside, you'll see they trade above double zeros again and come below it. They break out and pull back. They trade back up into it and go into consolidation right to the end of the Asian window. So that last doji pin bar is our Asian window. Now, again, the process is the same on gold and Nasdaq. The major pairs, I don't really feel like you need to use the 1 minute chart. The 15-minute bars are probably very clean in most cases, and the high-low stops are not, they're 8, 10, 12 pips. With gold and Nasdaq, the volatility can be higher, but the same process applies. Double zeros is locked in. They've already locked in the high of the day of double zeros. The highest bull candle, there's our geometry at the top of the box. It breaks down. They pop it up at the beginning of the session. Pop it up, engulfment. Pull it back, and again, now timing-wise, 15 minutes. 15 minutes. We get to the end of the 15-minute bar, and it starts to run away. It's already engulfed and breaking away at the beginning of the second 15-minute bar. And where does it go? To the low of the day. More importantly, though, when we burst out of that range, where does it break through? We have a 100-pip box. We can do a projected measurement just purely off the numbers. It does a full range expansion of 100 pips below the range. Now, it doesn't fill the gap, but we get pins down into 50. That moves over. The London session begins, and the same process applies. They engulf right in the London open of London. Second candle, they go sideways at double zeros before breaking through this lower high. Now, that engulfment takes out all the pins. That's locking in double zeros. Our double zero box now, potentially as a low of the day. Asia put the high in. London now may have put the low in. They're outside when they're down here. They're outside. The pins, the lows are all on the bottom. When they pull it back inside, we're inside of the range now. If this is a trade entry and you're trading this, or anywhere in here, you want to be trading in line with the existing trend back to the high of the day. So once they lock in the low, this market engulfs and breaks back inside of the original low of Asia, the low of the day. Let's pop that down, which again was the 50 pip box. We head into the next 12 candle window, and they've already locked in the consolidation low in the gap time. They hit the high of the day right off the bat of the Asian low. So we'll just project that across that lower peak. And you'll notice, bang, straight away they come back into breakout traders into that existing long trade before exploding up. This is where the New York Open is important. So they have put a new lower high in place. We have an existing high of the day from the gap time. So this could be the high of the day. Double zeros may still be the high. When this market goes up and pulls back before the New York Open in the second hour, this pin high now can be a reference point for the high of the day. This is a false breakout of that 15-minute range. They break out, and that's above 50, 50 to 75. This is our target strike zone if this is the high of the day. But more importantly, understanding the traders that are long have not been stopped out yet. They've put heat into people that are long, but they haven't been stopped out yet. So when New York opens, if we're opening up high, okay, so this is our high, our initial high. They went up, they went down and locked in double zeros and then took it up 75 pips. This is our peak formation that I said anything on that 15-minute bar above there could potentially lock in the high of the day. We see 1 push, 2 pushes, 3 pushes, and then the break in structure. They've come back inside. So this is the high of the day. They've broken out and failed. They come back up in the 15 minutes just prior to the New York Open. This little burst candle, which you'll see on level 3, a vertical candle and then a little bar, is the last minute just before New York opens. And there's 50 pips in 1, 2, 3, 4, 5, 6 minutes. Back to where the pump and dump began. So you hear me use that phrase all the time. This is before the market opens. They've taken it up 3 levels of rise. They've locked in the high. They take it back up into the high for the fast, explosive stop hunt. And if you don't take any money off or have a program target in or anything else, look how fast they come back up and get you. Straight back up, right to the high of the day, and then back down. Trading range. But the point being is that right at the New York equity market open, there's an explosive 50 pip move straight back to where the pump and dump began. So again, Nasdaq, just in terms of numbers, I just add an extra 0 for the bigger box. These are 250 pip boxes. So, anytime it breaks from one range to another, there's potentially 250 pip target. If it's a high-low, it could be a 500 pip box. Now, they went down in Asia. This lower high inside is a giveaway that they may be locking a low in and trapping people. So they've got people selling down in the middle of the box. So if you're just working from numbers, they come down to the previous day's low. They go sideways. They engulf it at the end of the 12 candle window in Asia. I'm not saying that these are where any trades are. With the Nasdaq, I predominantly just look at the New York Open. So again, it doesn't matter how much movement it's done through the day. I'm just trying to keep everything really simple and be able to go to the screen, London Open, Nasdaq, for Nasdaq, US Open, equity markets, and looking just for simple trades. So an example of where they moved it higher, they pulled back, they broke up again, pull back. There's our little engulfment at the end of the 12 candle window, peak formation at double zeros. They break that structure and pull back. So we'll zoom in here. Again, breakout pullback, locking in the zeros into an existing low. The low's already been locked in here in the gap time. Peak formation underneath double zeros. Now, how do we know that? We don't, but there's our inside bar bullpen hammer, and on the 1 minute, we see the same pattern that we just saw on gold, except that the 3 peak formation is on the bottom. Same setup. 1 push, 2 pushes, 3 pushes, the pullback inside, the engulfment right at double zeros. So this is prior to the New York market opening. So there's a long entry early before the market opens, but at 16:30, we don't see an explosion. We just see a pullback into, we see the explosion up and then the pullback, but the move continues higher into the next hour. So the low was locked in. But an example, just coming back to where the high of the day was right here. When they lock in this low, the first target is the high of the day. The New York market opens and bursts through. So even if you closed it on the burst through candle, that market closed 90 pips up from the double zeros. That's a 90 pip move. Now, when this market opens, you may have already taken money off. You thought that might wick down, whatever. But if you took the trade and just took it for 15 minutes into the new hour, that market still closed 50 pips away from the entry, roughly. 50 from double zeros to 50. So there are opportunities everywhere. But in this
traders, it's
particular
Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.